In 1793, France had 28 million people. Britain had 10 million. France controlled the largest army in Europe. France possessed more farmland, more iron, more manpower. By every measure of national strength, France should have buried Britain in a prolonged war. Yet, over the next 22 years, Britain spent $1.6 billion on warfare, more than any nation in history to that point. France, despite conquering most of Europe and seizing the treasuries of a dozen kingdoms, faced financial collapse 3 separate times. Napoleon sold Louisiana for $15 million because he needed cash. Britain bought it for him through a London bank. The armies at Waterloo fired muskets and cannons. The real weapon had been forged 121 years earlier in a cramped London office, when 1,168 investors handed over $1.2 million to create something the world had never seen. People think Britain won because of the Royal Navy. The Navy was the visible force. The invisible force sat in the City of London. A network of banks, brokers, and bond markets engineered over a century to do one thing: convert future tax revenue into immediate military spending at a scale no rival could match. France had gold. Britain had leverage. France taxed its people. Britain borrowed from its people, then borrowed from the Dutch, then borrowed from anyone with capital and the desire for a safe return. France extracted wealth. Britain created a machine that multiplied wealth while extracting it. The distinction matters. Gold runs out. Taxation has limits. Hit those limits and your people revolt. But a system designed around perpetual debt, liquid bond markets, and institutional credibility faces no such ceiling. You spend what you need, you pay interest forever, and your grandchildren inherit both the empire and the bill. This is Noob Historian. Every war, every empire, every revolution has a price tag. We find it. The system Britain built between 1694 and 1815 did not disappear at Waterloo. It migrated. First to Wall Street, then to the International Monetary Fund, then to the Federal Reserve. The infrastructure changes. The logic remains identical. Control the flow of global credit, set the terms of lending, and you control nations without firing a shot. Your mortgage rate connects directly to mechanisms invented by London goldsmiths in the 1690s. Your country's relationship with the dollar descends from the sterling system Britain imposed on world trade. When the United States freezes Russian assets or blocks Iranian banks from SWIFT, it deploys financial warfare techniques the British perfected against Napoleon. This is the history of how money became the ultimate weapon, and how the blueprints for modern financial power were drawn on the banks of the Thames 3 centuries ago. William III had a problem. He needed to fight France. He had no money to do it. The Glorious Revolution of 1688 brought the Dutch prince to the English throne. It also brought England into the 9 Years' War against Louis XIV. Wars cost money. England's finances were medieval. The crown borrowed from goldsmiths at ruinous interest rates. Tax collection was inefficient and corrupt. Royal credit was personal credit, meaning lenders constantly worried the king would default, die, or get overthrown. Louis XIV faced none of these problems. France had the most advanced tax bureaucracy in Europe. The French crown raised revenue efficiently and spent it on the largest standing army the continent had seen since Rome. By 1694, William's government had tried and failed multiple times to raise adequate funds. Traditional approaches had proven inadequate: a land tax, customs duties, a window tax. England needed approximately $36 million to prosecute the war. Available revenue covered a fraction. Enter William Paterson. Paterson was a Scottish merchant and promoter with a radical idea. Instead of the government borrowing from individual goldsmiths at variable rates, create a permanent institution. Pool capital from multiple investors. Lend the entire sum to the government at a fixed rate. Give the institution special privileges in return. On July 27, 1694, the Bank of England received its royal charter. Within 12 days, 1,168 investors had subscribed the full $1.2 million in capital. The government received the money immediately. In exchange, the bank received 8% annual interest plus a $4,000 management fee. The bank also received the right to issue banknotes up to the value of its capital. The mechanics seemed straightforward. The implications transformed Western finance. First, the bank solved the credibility problem. Individual lenders worried about lending to kings. Kings died. Kings got deposed. Kings defaulted. A corporate institution lending to Parliament offered different risk calculations. Parliament had proven in 2 civil wars its willingness to fight for its prerogatives. Parliament represented the wealthiest property owners in England. These property owners had direct financial interest in honoring national debts because they held those debts. Second, the bank created the first modern money market. Bank of England notes circulated as a medium of exchange. When merchants accepted these notes for transactions, they effectively endorsed the creditworthiness of the government. Each transaction spread confidence in the system. Third, the bank established the prototype for future government financing. The specific terms mattered less than the structure. Permanent institution, multiple investors, parliamentary oversight, privileged position in the financial system. Every major power would eventually copy this model. But the bank alone did not create British financial superiority. The bank was one pillar. The second pillar emerged from how Britain handled the debt the bank helped create. Britain's national debt stood at $1 million in 1688. By 1697, it reached $20 million. By 1714, it exceeded $36 million. By 1748, it approached $78 million. By 1783, following the American Revolution, it ballooned to $232 million. By 1815, after defeating Napoleon, it reached $834 million. These numbers should have crushed the British economy. They did not. Interest payments consumed substantial portions of government revenue, sometimes exceeding at 50%. Yet Britain continued borrowing at favorable rates even during major wars. The explanation lies in what historians call the funding system. Before Britain's financial revolution, governments borrowed for specific purposes and promised repayment by specific dates. Miss the date, and your creditors demanded payment, seized assets, or refused future loans. This created brutal liquidity. Crunches precisely when governments needed money most. War costs spike suddenly. Revenue collection lags behind. Short-term debt with fixed repayment dates generated constant crises. Britain did something different. Starting in the 1690s and perfected by 1751, the British government converted short-term debts into long-term perpetual obligations. The critical instrument was the consul, short for consolidated annuity. The government promised to pay a fixed annual interest payment forever. The government never had to repay the principal. If you held $100 in consols, paying 3%, you received $3 per year in perpetuity. You could sell your consols to another investor whenever you wanted, but the government never owed you the original $100. This structure offered enormous advantages. For the government, consols eliminated rollover risk. No maturity date meant no crisis when debts came due. The government only needed to cover annual interest payments, not principal repayment. During peacetime, tax revenues easily covered interest. During wartime, new borrowing funded both war expenses and interest payments on existing debt. For investors, consols offered liquid, tradable assets. The secondary market at the London Stock Exchange allowed holders to sell their positions whenever they needed cash. This liquidity made consols attractive even at lower interest rates. A Dutch investor holding British consols knew he could convert to cash within days. The same investor holding French government debt faced an illiquid market and questionable repayment prospects. The comparison with France proves instructive. France borrowed heavily under Louis XIV and Louis XV, but French debt instruments lacked liquidity. The French crown issued rentes, which resembled consols, but the market for trading these instruments remained thin. French investors worried about default. Louis XIV had defaulted. Louis XV's government manipulated interest rates and forced conversions. Each broken promise further damaged crown credibility. Interest rates tell the story. Britain borrowed at 3% to 4% during the 18th century, even during major wars. France paid 5% to 8% and frequently failed to find willing lenders at any price. This gap compounded over decades. Lower borrowing costs meant more money available for ships, soldiers, and subsidies to allies. Higher borrowing costs meant French finances remained perpetually strained even during peace. The men who designed the system understood the competitive advantage it created. Speaking to Parliament in 1737, Robert Walpole explained the system's logic with precision. A nation able to borrow at lower interest rates than its rivals commands structural superiority in any extended conflict. The rival exhausts itself paying creditors. The efficient borrower directs resources toward victory. By 1750, Britain possessed financial infrastructure no European rival had replicated. The Bank of England anchored the system. Consols provided unlimited, cheap credit. A liquid secondary market gave investors confidence. Parliamentary control assured creditors their money was safe. This machine needed one more component: private bankers willing to deploy it globally. The Bank of England handled government finance. But the British financial system extended far beyond government needs. International trade required credit. Foreign governments needed loans. War subsidies required complex transfers across borders. For these functions, a new type of financial institution emerged: the merchant bank. Merchant bankers began as traders. They shipped goods, sold commodities, and developed networks of trusted correspondents across Europe and beyond. Over time, the most successful traders realized financing trade generated better returns than conducting trade. They transitioned from moving physical goods to moving credit. Two families came to dominate this sphere: the Barings and the Rothschilds. Francis Baring founded Baring Brothers in 1762. By the 1790s, the firm handled trade finance across the Atlantic, managed government loan issuance, and advised both British and foreign governments on financial strategy. The Duke of Richelieu called Baring Brothers one of the 6 great powers in Europe, alongside England, France, Prussia, Austria, and Russia. The firm's most famous transaction illustrated merchant banking power. In 1803, Napoleon needed money. The war with Britain had resumed. The Louisiana territory cost France money to defend and generated minimal revenue. Napoleon offered to sell it to the United States for $15 million. The American government agreed but lacked the cash. France needed immediate payment in gold and silver, not long-term bonds. Baring Brothers arranged the transaction. The firm, along with the Dutch bank Hope and Company, purchased the American bonds at a discount. They then delivered the equivalent value in gold and silver to France. The Barings converted a geopolitical transaction into a financial operation, profiting from both the currency exchange and the bond discount. Napoleon received his money. Jefferson received Louisiana. The Barings received commissions and enhanced their reputation as Europe's indispensable financiers. The Rothschild family built an even more extensive network. Meyer Amschel Rothschild began as a coin dealer in Frankfurt. He placed each of his 5 sons in different European financial centers: Amschel in Frankfurt, Salomon in Vienna, Nathan in London, Kalman in Naples, and Jacob in Paris. This structure created something unprecedented: a single family operating across all major European financial markets, with perfect coordination and trusted internal communication. When Nathan in London needed to move money to Vienna, he sent instructions to Salomon. The family network bypassed the formal banking system entirely. Nathan Rothschild arrived in London in 1798. Within 2 decades, he became the most influential financier in Britain. His breakthrough came during the Napoleonic Wars. The British government needed to pay the Duke of Wellington's army in Spain. Wellington needed gold and silver coins. His soldiers would not accept Bank of England notes in Portuguese and Spanish marketplaces, but shipping gold from London to Lisbon risked capture by French privateers and cost enormous sums in insurance and transportation. Nathan Rothschild solved this problem through financial engineering. Instead of shipping gold, the Rothschilds purchased bills of exchange across Europe. These bills represented commercial debts owed between merchants in different countries. By buying and selling bills strategically, the Rothschilds moved purchasing power from London to Lisbon without moving physical gold. They used the family network to coordinate purchases in Paris, Amsterdam, Frankfurt, and other centers. The British government paid Rothschild in London. Wellington's army received coins in Spain. The Rothschild network captured the spread between purchase and sale prices across every transaction. By 1814, Nathan Rothschild handled so much government business, his operations affected the gold price across Europe. When he bought gold, the price rose. When he sold, the price fell. He learned to use information advantages ruthlessly. Rothschild couriers moved faster than government messengers. Nathan frequently knew the outcome of battles before the British cabinet. The merchant banking system these families dominated served crucial functions in Britain's financial architecture. First, merchant banks distributed British government debt to foreign investors. Dutch, German, and Swiss capital flowed into consuls, providing Britain access to the savings of all Protestant Europe. This capital pool dwarfed what British domestic savings alone could provide. Second, merchant banks financed trade in ways that strengthened British commercial dominance. A Brazilian coffee exporter or an Indian cotton merchant needed credit to ship goods. Merchant banks provided this credit, denominated in sterling, settled in London. Every trade transaction reinforced sterling's position as the global commercial currency. Third, merchant banks became instruments of foreign policy. When Britain wanted to strengthen an ally, Rothschild or Baring arranged a loan. When Britain wanted to weaken an adversary, London capital markets closed to them. Access to the City of London became a tool of statecraft. Britain's financial advantages crystallized in a single policy decision: the formal adoption of the gold standard. The principle was straightforward. The Bank of England stood ready to exchange its notes for gold at a fixed rate. Anyone holding pounds could redeem them for physical gold. This convertibility anchored sterling's value and created confidence in British money worldwide. Britain had informally operated on gold since 1717, when Isaac Newton, as master of the mint, set the gold to silver ratio in ways that effectively demonetized silver. The Coinage Act of 1816 and the Resumption Act of 1819 formalized gold convertibility after the wartime suspension. The gold standard provided Britain several advantages. For international trade, gold convertibility eliminated exchange rate risk. A merchant in Buenos Aires selling beef knew precisely what British pounds would buy in gold terms. This certainty encouraged commercial relationships denominated in sterling. Sterling became the preferred currency for international contracts because its value was predictable. For investors, gold convertibility provided an exit option. If Britain ever appeared financially irresponsible, investors could convert paper pounds to gold and withdraw from the system. This discipline constrained British monetary policy, but the constraint signaled commitment. Investors trusted sterling because they knew Britain could not inflate away debts without triggering gold outflows. For Britain's financial sector, the gold standard created natural demand for London's services. Countries wanting to hold reserves needed gold or currencies convertible to gold. Sterling qualified. They deposited reserves in London banks, which then lent these funds to British industry or back to the depositing countries at higher rates. The system concentrated global financial flows through London. By the 1870s, over 60% of world trade was financed in sterling. The bill on London became the primary instrument of international commerce. A Japanese silk merchant shipping to New York received payment through a bill drawn on a London bank. The silk never touched Britain. The money flowed through London anyway. Other nations adopted gold standards to gain credibility with London investors. Germany went gold in 1871 using French indemnity payments. The United States effectively joined in 1879. France, Belgium, Switzerland, and Italy operated gold systems by the 1880s. Each adoption strengthened the network while reinforcing London's central position. Britain did not force these adoptions through military pressure. The financial incentives sufficed. Countries on gold could borrow in London at lower rates than countries on silver or paper. The interest rate differential encouraged voluntary compliance with the British monetary order. This structure parallels the modern dollar system precisely. Countries today hold dollar reserves not because the United States forces them, but because dollar liquidity offers advantages no alternative provides. Oil trades in dollars, commodities price in dollars. The deepest, most liquid financial markets operate in dollars. Each transaction reinforces dollar dominance, generating demand for dollar assets that keeps borrowing costs low for the United States. Britain occupied this position from roughly 1870 to 1914. The advantages compounded annually. Low borrowing costs funded imperial expansion. Imperial expansion secured raw materials in captive markets. Profits from these markets flowed through London banks. London banks recycled profits into loans to other countries, creating dependencies and earning interest. The Napoleonic Wars tested Britain's financial system against the largest military force Europe had seen since Rome. Napoleon understood military logistics with genius. He moved armies faster than any commander before him. He won battles through concentration of force and decisive maneuvering. His soldiers conquered Italy, Germany, Austria, Prussia, Spain, and marched to Moscow. Napoleon never understood finance with equivalent depth. This gap proved fatal to his ambitions. The emperor's strategic vision relied on the continental system. Close all European ports to British trade, strangle the island's economy, force Britain to terms without invasion. The plan had logical foundation. Britain imported food and raw materials. Britain exported manufactured goods. Sever these trade links, and the British economy should collapse. The continental system failed because Napoleon could not sever British financial links. British credit continued flowing to smugglers, neutral merchants, and resistant populations across Europe. British gold subsidized every coalition raised against France. British bills of exchange purchased supplies for Wellington's army from Spanish and Portuguese merchants, supposedly under French influence. Nathan Rothschild's network exemplified British financial penetration of Napoleon's Europe. The Rothschilds operated in Paris, Frankfurt, and Vienna throughout the wars. They maintained correspondence in cities nominally under French control. Gold and credit flowed through this network despite every French attempt at interruption. The numbers demonstrate British financial superiority starkly. Between 1793 and 1815, Britain spent approximately $1.6 billion on the wars. This sum covered the Royal Navy, the Army, subsidies to allies, and interest on borrowing. Roughly $66 million went directly to foreign powers as subsidies. Austria, Prussia, Russia, Spain, Portugal, and various German states received British gold to field armies against France. France, despite controlling most of Europe, could not match this financial output. Napoleon extracted resources from conquered territories through tribute, plunder, and forced requisitions. These methods generated immediate cash, but destroyed the economic base needed for sustained extraction. Occupation costs exceeded revenues in Spain and elsewhere. Resistance movements and economic depression reduced taxable capacity across French Europe. French government finance reflected these strains. Napoleon conducted major campaigns with war chests, accumulated before campaigns began. When these ran out, he struggled to continue operations. The 1812 Russian campaign depleted French reserves. The 1813 campaign to hold Germany began with inadequate funding. The 1814 defense of France operated on a collapsing financial base. Britain's borrowing capacity showed no equivalent constraints. The government issued new bonds throughout the wars. Investors purchased them. The Waterloo campaign itself illustrated the financial dimension of the conflict. Wellington's army required approximately $1 million monthly for operations in Belgium. The Treasury raised this sum through a combination of current revenue, short-term borrowing, and bond issuance. Nathan Rothschild handled much of the actual cash flow, purchasing gold on European markets and delivering it to military paymasters. When Napoleon escaped Elba in March 1815, he found the French treasury empty. He raised funds through forced loans and seizures from wealthy opponents. These methods generated approximately 12 million francs before Waterloo. Britain allocated $9 million for the campaign in the first weeks. The financial mismatch guaranteed Napoleon could not sustain prolonged operations, even if he won initial battles. The British system demonstrated resilience under unprecedented strain. 22 years of war, national debt increasing from $228 million to $834 million. Annual interest payments tripling. Through all of this, British credit held. Investors continued purchasing consols. The currency remained convertible to gold within months of peace. France required decades to recover financially. Britain emerged as the world's uncontested creditor nation. The financial system Britain built between 1694 and 1815 did not end at Waterloo. It evolved, expanded, and eventually transferred across the Atlantic. Understanding this evolution explains your current financial reality. The Bank of England model spread first. The first Bank of the United States, chartered in 1791, explicitly copied British designs. Alexander Hamilton studied British financial operations and replicated their structure. A central bank funded government debt, banknotes circulating as money. The Federal Reserve, created in 1913, refined these principles while maintaining the same fundamental architecture. The console model spread next. Perpetual government debt, traded on liquid secondary markets, became standard across developed nations. Today, you call this infrastructure the bond market. When your government borrows, it issues bonds structured on principles the British Treasury developed 3 centuries ago. When the Federal Reserve conducts monetary policy, it buys and sells government bonds on secondary markets the British created. The merchant banking model transformed into modern investment banking. Baring Brothers survived until 1995. The Rothschild family still operates banks across Europe. Goldman Sachs, Morgan Stanley, and J.P. Morgan perform functions identical to their 19th century predecessors, underwriting government debt, financing international trade, advising on mergers and strategic transactions. The gold standard ended formally in 1971 when Nixon closed the gold window, but the underlying structure persisted. The dollar replaced sterling as the anchor currency. Instead of convertibility to gold, the system now relies on American military power, American financial market depth, and American institutional credibility. Foreign governments hold dollars and dollar-denominated assets for the same reasons their predecessors held sterling: liquidity, safety, and network effects. The City of London survives as a major financial center despite Britain's relative economic decline. This persistence demonstrates how financial infrastructure creates path dependencies. Expertise, relationships, legal frameworks, and institutional memory accumulated over centuries. These assets depreciate slowly. New York gained ground after 1914. Singapore and Hong Kong rose in Asia. But London retained sufficient advantages to remain among the top 3 global financial centers a century after losing its commercial supremacy. Modern financial warfare operates on principles the British pioneered. When the United States freezes Russian central bank assets or excludes Iranian banks from SWIFT, it deploys the same strategic logic Nathan Rothschild and the British Treasury applied against Napoleon. Control the infrastructure of global finance, and you can damage adversaries without military engagement. China studies this history carefully. The Belt and Road Initiative extends Chinese credit to developing nations, creating financial dependencies. The Asian Infrastructure Investment Bank offers an alternative to Western-dominated institutions. Digital yuan pilots explore possibilities for transaction systems outside dollar networks. Chinese strategists understand the British playbook. They seek to build equivalent infrastructure with Beijing at the center. The competition between American and Chinese financial systems will shape the 21st century. The outcome depends on factors the British experience illuminates: institutional credibility, market liquidity, rule of law, network effects, and the willingness of foreign actors to trust their wealth to your system. Your personal financial life connects to this architecture in ways you likely do not perceive. Your mortgage rate reflects Federal Reserve policy, which reflects government borrowing costs, which reflect mechanisms invented in the 1690s. Your pension fund holds government bonds traded on markets designed in the 1750s. Your currency's value depends on international arrangements descended from the gold standard Britain imposed on world trade. The British did not build this system through accident or genius alone. They built it through institutional evolution, competitive pressure, and the reinvestment of advantages over generations. A small island needed to outspend continental powers. That need drove innovation. Innovation created infrastructure. Infrastructure generated advantages. Advantages compounded. The families who financed British dominance became embedded in the system they created. Rothschild descendants still manage wealth. Baring name survives in financial services. The Bank of England still sets British monetary policy. The City of London still clears international transactions. The past is not past. It operates continuously in systems we use without understanding their origins. When you trace money flows and power relationships, you find the fingerprints of London merchants and Scottish promoters from 3 centuries ago. They built the machinery. We still live inside it. The lesson is not nostalgia for British power. The lesson is structural. Nations that control financial infrastructure exercise power beyond their military or productive capacity. Nations that depend on foreign financial infrastructure find themselves constrained in ways they rarely recognize until crisis arrives. Russia learned this lesson in 2022. Other nations will learn it in the decades ahead. Britain did not conquer the world with armies. Britain conquered the world with bankers. The bankers created systems. The systems outlasted the empire. You navigate those systems daily. Now you understand where they came from.